Hey guys, we wanted to tell you a little bit about reverse mortgages, how they work, and how they can be beneficial. The main advantage to a reverse mortgage is that you get to eliminate the need to make a monthly mortgage payment, but you still get to own your home and you still get to live in your home. If you're on a fixed monthly income, eliminating a monthly mortgage payment can make a huge difference and improve your quality of life. The way this works, of course, is the interest and fees on your loan accrue on top of the principal balance every month. So each month, your balance does go up, not down. Even though you get to eliminate a monthly mortgage payment, the taxes and insurance are still due on your property like normal. There are some eligibility requirements to apply for a reverse mortgage. First, you must be 62 years of age or over, and you must live in the home for the duration of the reverse mortgage loan term. Age matters here, guys. So, for example, older borrowers can access more of the equity in their home, while younger borrowers can access less of this equity. Let's talk about some added benefits to a reverse mortgage. So again, if you're retired or on a fixed monthly income, by eliminating the need to make a housing payment, you free up more of this income and get to stay in the home that you love. Again, this makes a huge difference in the quality of life. Also, you can use the funds from a reverse mortgage to consolidate things like credit cards. So imagine eliminating your credit card payments or your car payments, again, freeing up more of your monthly income. You can use the funds from a reverse mortgage to pay for things like in-home care or make home modifications, things like a stair lift, special beds, or ramps. You can also use these funds to supplement your retirement accounts, especially if they're running low. This can help to sustain your lifestyle as long as possible. Let's look at an example of a reverse mortgage. Here we have Mary Ellis. Mary is 82 years of age. She has a 700 FICO score. Her home value is $495,000. Mary owes on her existing mortgage $74,000. She pays $1,342 per month in principal and interest payments. Mary would like to pay for in-home care, and she needs to supplement her income as her retirement assets are running low. Let's look at her loan example. First, Mary starts with a maximum loan amount of $259,000. This is about 52% of her home's value. After we deduct for her mortgage payoff, closing costs, and FHA's upfront mortgage insurance, Mary is left with $172,000. Now, guys, a quick note about FHA's mortgage insurance. This is what makes reverse mortgages possible. FHA insures lenders against losses on reverse mortgages. Now, remember we said age matters. So if Mary had been 90 years of age, she would have a maximum starting loan amount of $313,000. After mortgage payoff, closing costs, and again, FHA's upfront mortgage insurance premium, Mary would have been left with $226,000. So this gives you an example of how age makes a difference. Now, Mary has some distribution options or different ways that she can take the funds from her reverse mortgage. So first, Mary can do a lump sum payment. On year one, she'd have access to about $68,000. After that, on year two, she would have access to another $103,000. Mary can take these funds as an equity line or as a lump sum. Or Mary can use all of the funds as an equity line and draw upon that line as needed. She can also take a fixed monthly amount. So for example, Mary could take $5,000 a month for the next 55 months. Lastly, Mary could take what are called tenure payments. So every month, Mary would receive $1,938 per month for as long as she lived in the home. Now, one important note here, guys, is that the different options that you choose for distributions may impact closing costs one way or the other. Let's not forget that there's an added benefit here to Mary. She's eliminating her monthly mortgage payments of $1,342 per month. That goes back into her income. Now, Of course, Mary's loan balance does go up, so we need to take a look at what happens on a reverse amortization. On year one, Mary's balance would be $167,000. She would still have a remaining equity line of $111,000. Mary's estimated home value would also increase $514,000, and she'd have an estimated home equity of $347,000. On year five, Mary's loan balance is $224,000, and she has a remaining equity line of $149,000. Let's not forget here, guys, that Mary is also going to be saving or retaining $80,000 of her income over that time. We expect this rate to be 7.10%. This is variable and can change over time, up or down. Hopefully, they go down. Some facts to remember: you never owe more than the value of your home. You can also make payments at any time. You do have the option between fixed or variable rates as well. Guys, that's a brief example of a reverse mortgage. If you have any other questions, please reach out to us. We'd love to answer them for you. Thank you.